Welcome to this explainer on the source material behind corporate financial blueprints. Whenever you look up at a towering, magnificent skyscraper, you know that long before the very first piece of glass or steel went up, there was a meticulous, highly detailed architectural blueprint. Well, in the corporate world, a company's financial statements are exactly that. They're literally the structural blueprints of a business. So today, we're going to figure out how to read these master plans. We'll explore how to prepare company financial statements in their modern vertical form. We'll get acquainted with some really vital concepts like reserves, provisions, profit, and capital. And ultimately, we're going to appreciate the uses and the hidden limitations of these numbers. Let's get into it.
Okay, let's dive into this. Here is our roadmap for how we're going to inspect this blueprint layer by layer. First, the vertical upgrade. Then reserves versus provisions, followed by the many faces of profit, understanding business capital, who uses financial statements, and finally, the limits of the numbers.
Section 1. The vertical upgrade. A modern foundation.
Remember those classic, kind of clunky horizontal T-charts from old accounting classes? The ones with liabilities awkwardly sitting on the left and assets on the right? Well, today, modern corporate reporting has totally evolved. The Companies Act now prescribes a sleek, single-column vertical format, and it's become the absolute standard practice. The top half acts as your sources of funds. This explicitly answers where the money is coming from, listing out things like share capital, reserves, and loans. Then, the bottom half is the application of funds. This tells us exactly where that money is going, mapping out your fixed assets, investments, and working capital. It's brilliant because it transforms what used to be a static snapshot into a really clear chronological story of where a company gets its cash and how it deploys it.
And that same elegant top-to-bottom logic applies to the income statement too. You start with the absolute top-line revenue, and then you systematically bleed out the expenses, materials, operations, financial costs, depreciation, until you see exactly what survives the journey to the bottom line. It guides you through a perfectly logical narrative of operating, investing, and financing activities. It makes it incredibly easy to track the actual financial survival rate of a company's revenue.
Section 2. Reserves versus provisions. The safety nets.
Now, what's really interesting about this is how we protect a company from future shocks using two very different safety nets. Think of a provision as a strict liability bucket. It's a completely non-negotiable charge against your profits, created for a known liability. You have to do it even if you can't determine the exact dollar amount with perfect accuracy. So this covers things like bad debts or upcoming repairs. A reserve, on the other hand, that's your rainy day fund. It's an appropriation of profit for unknown future contingencies, like a general expansion or simply just reinforcing a strong financial position.
The key difference here really comes down to creation. A provision is a mandatory charge against profit. That means you absolutely must create it, even if you're taking a massive loss for the year. If you know an asset's value is dropping, you have to provide for it. A reserve, however, is a luxury. It's an appropriation, which means it literally only exists if you actually made money. Plus, reserves can eventually be distributed as dividends to shareholders, while provisions stay firmly locked inside the business to cover those known liabilities.
Section 3. The many faces of profit. Peeling back the layers.
Let's move on and see how this builds, because management quickly realizes that profit isn't just one monolithic number. It's a layered story. We slice through gross profit, we deduct our everyday operations to get operating profit, we account for interest to hit profit before tax, and then we pay the government to arrive at profit after tax. But the ultimate truth teller of a company's health? That's step 5, cash profit.
Now, you might be wondering, why do we add back non-cash charges like depreciation? Well, because depreciation is basically an accounting ghost. No actual cash left the bank account when that expense was recorded. Adding it back reveals the true hard liquidity that was generated by the business operations for that year. It's reality versus paper. It completely separates theoretical accounting earnings from the actual physical money flowing into the corporate treasury.
Section 4. Understanding business capital. The structural support.
Okay, capital employed isn't just the initial money the owners pitched in at the very beginning. It's the total financial muscle deployed by the enterprise. It is a heavy-duty combination of the paid-up share capital, the accumulated reserves and surplus, and all the long-term liabilities, like your bank loans and debentures. Together, these components make up the structural, weight-bearing columns driving the business's fixed assets and net working capital forward.
So the crucial point is, when we're calculating capital employed, we want to measure the tangible, actually deployed finances. This means we strictly exclude non-business investments. And more importantly, we subtract fictitious assets and generated intangibles where no actual payment was made to acquire them. Things like internally generated goodwill, patents, or a debit balance in the profit and loss account, those are completely wiped from this calculation. True capital analysis relies on hard reality, not paper valuations or accounting wishful thinking.
Section 5. Who uses financial statements? The inspectors.
It's a fiercely diverse group of inspectors out there, and they are all dissecting the exact same document for completely different reasons. Investors are hunting for intrinsic value and earnings per share. Trade unions and employees, they're weaponizing those exact same profit numbers to negotiate wage hikes and bonuses. Creditors and bankers are sweating over liquidity to make sure their loans are safe. Management is using these past numbers to draft future budgets, while government bodies rely on them to squeeze out taxes and enforce regulations. Everyone starts with the exact same vertical columns.
Which brings us to a really crucial question. With everyone from union bosses to Wall Street bankers relying on this one heavily regulated blueprint, do these precise, highly structured numbers actually tell the whole truth? Section 6. Limits of the numbers. The blueprint's blind spots.
Here's the thing. They are perfectly detailed yet perfectly blind to non-financial realities. Your brilliant management team, your bulletproof brand reputation, the raw, unmatched skill of your employees, the balance sheet simply doesn't care. It doesn't see them. Furthermore, these statements are strictly historical. Because of standard accounting conventions, fixed assets are shown at their historical acquisition cost, less depreciation, not what they could actually sell for today. And crucially, these statements are entirely descriptive, not explanatory. They show you exactly what the profit was, but they leave you totally guessing as to why it happened.
Actually, scratch the idea of perfect objectivity too, because there is a surprising lack of it hiding behind those rigid columns. Estimating the useful life of a machine to calculate its depreciation, or choosing between different inventory valuation methods based on the principle of conservatism. Guys, these are human judgment calls. These flexible, discretionary accounting principles mean that two different accountants could look at the exact same business and paint two wildly different pictures of solvency and profitability.
As the source material puts it beautifully, accounting is the language of business, but financial statements do not speak themselves. The blueprint gives you the structure, for sure, but human interpretation gives you the truth. So the next time you look at a flawless vertical balance sheet, ask yourself, what story are the numbers trying to tell? And more importantly, what story are they trying to hide? Thank you so much for exploring this explainer of the source material with us, and keep questioning the numbers.